This
wait a few
conference will
minutes.
now be recorded.
We're going to wait just a few minutes. We had a number more people that had registered for the webinar, and they may be on the line listening and not actually on the webinar visually. That might be part of the issue, but we're just going to wait a few minutes to give those that had registered that aren't on a chance to join. But we'll get started in just a couple minutes.
This conference will now be recorded.
All right, well, good morning, everyone, and thanks for joining us today. This is the fifth in the series of Iowa Poultry Association webinars, and just as a reminder, these webinars are recorded, so if you would like to come back and listen to this webinar again at a later date, you simply go to our website and you can access that recording, or if you'd like to reference other people within your company or your organization to listen in, they can do that also at a later time that fits their schedule. With us today, we have Michael Liautaud and Eric Labe from CIH, and they're here to share with us some information related to a market outlook and strategy suggestions for current market conditions. We're going to focus a bit today on certainly the recent release of the World Ag Supply and Demand Estimate report that's just been issued. They're also going to talk about USDA's crop acreage estimates that were released the end of June, and some of the USDA economists' estimates on how tariffs are going to impact markets. It's really an opportunity for us to gain additional insights and information as we look to the future for what the forecasts are from a grain markets standpoint, but also looking at strategies on how each of you can handle those markets. So just real quick, Mike Liautaud is the Manager of Education and Research team at CIH, and he works in particular with ag industry participants in gaining an understanding of margin management concepts and strategies. I'll let you read the rest of his bio on your own. And Eric Labe is the lead for CIH's commodity price management and ethanol margin management team, and works with all of their team of buyers in North America, Asia, and Europe. And he works specifically in the area working with layer, broiler, and turkey clients on a daily basis. So with that, I'm going to turn it over to Mike and Eric and let them walk you through today's presentation.
Excellent. Thanks, Kevin. And thank you, Iowa Poultry Association, for inviting us. Really appreciate the opportunity to share some good news, actually, for commodity buyers over the next 45 minutes to an hour or so. Just starting out, we're going to give a big picture overview of what's happening in the corn and soybean meal markets. Obviously, this is information that's already occurred. Kevin mentioned tariffs. I wish I knew the answer to what is going to happen in the future with in regards to that, but we have some information, some things that we'll share there that may be interesting, or at least something to consider and think about as you begin to develop biases for the future price action for these commodities. With that, I've got a lot of slides to cover, so I want to get some time for question answer, as well as time for Eric to review some strategies. Let me just dive into the corn outlook that we've got presented here today. This price graph is showing the price of December 2018 corn futures since May of last year, so planting last year up until the beginning of this week. As of today, corn prices are actually a little lower than what's displayed on the screen there at $3.67. But you can see, going into last year's summer growing season, prices had ranged between $4 and $4.20, into harvest falling back to $3.80. And then we had a rally going into spring, into summer this year. Obviously, we had some South American issues. We had the expectation for a lot of trade to occur, some good demand from ethanol, and since we've fallen off a cliff, quite literally, and that's due to several factors that we're going to get into in just a little bit. But that's just an overall view of what price action has done. I'm sure most all of you are aware. This is a snapshot off of the website we've developed to help producers identify risk, and this is one of the tools, a statistics page that shows where that December corn price of $3.67 per bushel, how that ranks over certain periods of time. So over the last 1 year, 3-year, 5-year, 10-year, and 15-year terms, where does 367, where does that fall on the scale? Yeah, so 10 years will include even the big old ethanol boom and include everything post-ethanol. If you notice, that ranks at the 10th percentile of price over the last decade. In other words, 90% of the time, corn prices have been higher. That's a pretty interesting statistic, I would hope, for some buyers. That's not to say that corn prices cannot get to this 10-year low of $3.06. Now, this is looking at just board price. Obviously, depending where you're at in the country, there's going to be basis that would be either added or subtracted from that value. But just board price, we're looking at a very low level, which obviously is very good for buyers. But the question is, will that stay? For the foreseeable future, most likely. Over the next 5 years, I don't know. Obviously, it's a very fluid environment, and we have several growing seasons ahead of us. And so the futures market provides an opportunity today to start looking forward out in time and begin managing risk for future production periods. Let's briefly talk about the supply and demand report. There was a lot going on. There's a lot of numbers that you're going to see on this screen. I want to focus on, though, primarily the last 3 columns here on the right. The columns here in the middle, I guess, of the screen are showing the differences, the changes in the 2017-18, or the old crop position. And while important and driving prices for nearby spot market conditions, the marketplace is generally more focused on new crop, what's growing in the fields, and how that might actually affect future prices 6 months to 12 months out in time. So the USDA yesterday, World Agricultural Outlook Board, WAOB, incorporated the June 30th, or I guess it was the 29th, I think, acreage report numbers, showing that there's going to be an increase in corn planting from the initial March estimate of 1.1 million acres. Right now, they have estimated that all 1.1 million will be harvested. So that's increased the base, obviously increasing supply by 190 million bushels. And obviously that's a good thing for a buyer, because more supply means more availability and likely less prices, unless obviously demand changes. The USDA chose not to adjust any yields, which is, I guess, par for the course in July. We've got a very important next 3 weeks ahead of us, depending on how early or late you were in the planting field this year. But as we get into August, we'll get real yields, actual surveyed yields, and that'll obviously change the picture even further. Demand was adjusted some. Exports increased by 125 million bushels. I'm going to get more into demand here in a second, but bottom line, we're going to have an expected carryout as of September 1st, 2019. It's crazy to say that year. 2019, September 1, of 1.552 billion bushels. As you compare that to last year, obviously that's 25% less than last year's ending supplies, or expected ending supplies as of September 1 of this year. But still not very tight relative to history. Maybe on a stocks to usage basis, yes, but have ample supply. Let me talk a little bit more about that supply. obviously, and I don't have a chart, unfortunately, right this second to show you of 5-year, 3-year price action, but anyone on the line is probably familiar that prices haven't been over 450 or much below 350 over the last couple of years. Mother Nature has a way of correcting things, and after the drought of 2012, yields have come back towards trend, towards records, ever-increasing seed technology, improving yields. And so the trend continues and expected to continue even at the end of this growing season. Weather outlooks right now are completely favorable based on the ERS yield model that was published back in 2013. Market participants are already expecting that the USDA's 174 corn yield will likely be closer to 176, 177 by the time we get to the end. This next slide probably doesn't look all that exciting on the face. That said, what I wanted to do, incorporate it, was to kind of give you a macro idea of corn demand, I guess. I know we're looking at an acreage chart here, but there's a dashed line I'm going to throw across the screen. This is showing my history, at least this is from the USDA. So the USDA's publication of planted acreage from 1971 to present, so including that 89 million acre figure for this year. The dashed line ends somewhere near the beginning of the ethanol boom. So for that, what is that, 30, 40 years or so, 30 years plus, corn acres range on a high end of maybe 84 million down to about 70 million on the low end. But really, there was no big growth in corn acreage over that period. What started happening, though, after the ethanol era began, was an increase in acres due to demand. Okay, so is that demand going to continue to grow? Will we need to require more acres? These are questions the industry is asking itself, and well, we'll see. We'll see what happens with Congress. That's something that nobody can predict in the ethanol mandate. But I want to show some demand slides to kind of give you a picture on whether or not we might need more acres. This chart, this is a chart of overall corn demand on an annual basis. Each bar represents a different category, so you'll see there's 3 colored bars stacked on top of one another. The blue bars on the bottom represent feed and residual usage. This is livestock feed. The red or maroonish bar would be, other food, seed, and industrial usage. And as of it looks like 1985, the USDA or the government started breaking out the ethanol and byproducts piece of the demand. Notice what demand for feed and residual, which has been the lion's share of usage throughout history. Look at that demand has done since the mid-90s. Pretty stagnant, hasn't grown much. Efficiencies have picked up. Substitutability of other products, other feedstuffs has occurred. And so demand for feed use of corn really hasn't increased all that much. What has increased, though, the overall demand picture, the reason why we are now demanding somewhere in the order of 13, 14 billion bushels is because ethanol. Okay, so let's talk about ethanol. The yellow bars there contributing to that higher demand total. This is now breaking out those yellow bars. Now they've turned into blue, and this is looking at ethanol in a million bushels, I guess, over the last 20 plus years. Okay. Obviously back in 95, 96, 99, we're using corn to produce ethanol. We've been doing that since the 80s. But since the government mandate, corn usage for ethanol has been on an exponential rise. Going into 2009, 10, going into the Great Recession, I hate that term, but it really was. It's reset everything. Demand kind of stagnated. We rethought, I say we, the government, rethought, their aggressive idea on usage. And so what's happened over the last 6 or 7 years is that, yes, demand for ethanol has increased, but at a much more moderate pace. So couple the idea that why did acres increase? Acres increased because of new demand. That new demand was ethanol, and that is moderating to some degree. And so I don't know. Again, I wish I had the future, the crystal ball on how the EPA will come out and what will occur from the mandates. That said, obviously, I think the U.S. will continue to be or want to be an energy efficient country, and the demand for ethanol will stay. That said, we'll see what the future holds. Let's talk a little bit about exports and NAFTA. How I wanted to talk about NAFTA, obviously there's nothing formal yet. There's ongoing negotiations. There's a new Mexican president. Politics is a crazy game, I guess, these days, and that what you thought you knew, you didn't, and likely what you think is going to be the opposite. So I don't like guessing on what the effects or what the outcomes of any negotiations are going to be until we get there. But let's put into context some of the benefits related to corn that NAFTA has given. Okay. So let's explain this graphic. I just put this together last week. I wanted to understand the economic benefit that corn farmers, and obviously to your disadvantage as buyers, but to corn farmers, what NAFTA has done. Each blue dot here on the left, and I chose 24 years before NAFTA and 24 years after NAFTA because that's today. NAFTA has been engaged for 24 years, so you've got an equal distance on either side of the signed document. Each blue dot here represents where Mexico ranked, out of all the countries we shipped corn to, where Mexico ranked that year as far as a destination for volume. Okay, so Japan has ranked as #1 for a very long time. And, over these years, Mexico, through some production issues, has become a larger buyer. Definitely back in the 70s and 80s, though, a much smaller buyer of U.S. corn. Notice, though, what happens after NAFTA is signed. Looking at the red dots here now to the right. The lines that are drawn are showing the average for that period. The average pre-NAFTA position for Mexico, they ranked as a 10th largest destination for our shipments. Now Mexico ranks at 2. They're the 2nd largest destination for our exports. And aside for this year right now, and that's data as of May of 2018, Mexico had ranked #1 over the last 3 years. So it'll be interesting to see what will occur as a result of these negotiations. Obviously, we had better trade. Dairy was one of actually the biggest beneficiaries of NAFTA. Obviously, though, corn reducing tariffs. Tariffs is a 4-letter word today, but we'll talk more about that later with soybeans. But something that's been good and helping demand. If that does get ripped up, again, I don't know what happens to price, but there could be significant impacts to lower prices if that occurs, because Mexico does have other choices in the world. Now, let's quantify it, though. How much of an impact? I'm not an economist. I don't play one on TV, so I don't want to even pretend to know what the potential economic impact will be. That's why I put together a list or a statistics page of where corn prices have ranged over the last 15 years. It kind of helps filter out a lot of the noise, and that's a lot of what we're getting these days is a lot of noise, not a lot of actionable information. Pre-NAFTA, the Mexican imports of our corn represented 4% of our export market. 4%. That's it. That's where the 10th place represented. Now, if you take the average, and obviously you can see here that over the last, counted out, 7 years, 8 including 2018, we've been above this average line, approaching even almost 30% of our export market for corn goes to Mexico. So you're looking at, roughly 600 billion bushels that are going to Mexico if we're exporting 2 billion bushels. Okay, but we've been on average shipping at about 16%. So it could be potentially a decent economic impact if something bad happens with NAFTA. Now, This chart here is showing you what corn exports have done over the last, several weeks. This is kind of, not confusing. I know how to explain it, I guess, but it's hard to understand just at first face value looking at it. What does this mean? This gray bar, or this gray area chart, represents what the shippers of our country need to ship out on a weekly basis to meet the current USDA estimate for exports. Okay? So if the blue bar, which is what we actually shipped, goes right up to that gray bar, so if we actually ship exactly up to this amount every single week, by the end of the year, we will meet the USDA estimate head on. Obviously, that doesn't occur. So what this is doing is trying to filter out any seasonality in corn shipments, when people tend to buy or when people tend to hold off their purchases. The green line here is actually being measured off of the right axis, and it's showing how much ahead or behind the USDA forecast we are at any given time. So you'll notice here at the beginning of the year, September 1 starts the crop year for corn. For the first, call it 20, 30 weeks or so, 20 weeks, corn shipments were significantly behind what was needed to meet the USDA estimate. And that's why prices were languishing going into the new year. We obviously, y'all are probably familiar and aware, we'll talk more about this in about 15 minutes, but South America, primarily Argentina, had some weather issues. And so when weather issues pop up, buyers go and search for supply, some sort of reliable supply. So our corn export sales began picking up pretty dramatically. And this is a measure of our shipments. So it's great to sell something, but if it doesn't ever leave port, it doesn't count, quite honestly. They can always cancel it for a fee. So this is representing shipments. And ever since, the middle of March here, we started turning higher. And right now, shipments for corn are doing good, and that's helping to support the spot market. So that's an overview of supply and demand relative to corn from a domestic standpoint. Here's ending stocks. This is looking at million metric tons. The world looks at things on the metric scale, so do we. You see here that this is the 15 billion bushel, 1.5 billion bushel number represented in metric tons. So roughly 40 million metric tons of corn will still be on hand by the end of the crop year. At least that's what the estimate is today. Where does that rank over the last decade? Why are corn prices low, and why are they expected to remain low? Well, it's because supplies are ample. We're not looking at a 2012 situation or a 2003 or 4 situation. This is, very ample over the last 10 or 15 years. Now, to put this number, though, into context, we have to divide that ending supply into how much we're demanding. It's good to know how much we have left, but if we're demanding a lot, that could become a very small amount, even with a fractional issue around the world. This last dot, and this is what economists will use to measure relative value, if you will, or where price levels may tend to gravitate towards. Right now, we're sitting around that 10% in the stocks to usage category. When we start getting below 7, 8%, as we did here in the 09, 10, 11, 12 markets, I guess that's 10, 11, 12. And that's when you saw, obviously, commodity prices increasing dramatically. Supplies were shorter than demand, and you saw large spikes in price. Recall the 1995 corn market, when this was the first year that corn breached the $5 mark. And that's why we look at this measure. We like to look at the trends. And so, yes, from a domestic standpoint, supplies have gotten tighter relative to demand. Now, that's because acres have come down. So maybe we're doing a little rebalancing here domestically. If we have some sort of international issue, that definitely could perk up our corn demand through the export market. That said, we'll see if that ever happens. Okay. Lastly, I want to talk about the global supply and demand fundamentals. Not a whole lot to talk about here. I don't really want to get bogged down too much on the details of some of the different areas of the world. Suffice to say, the world has enough corn at present, not as much as they have in the last couple of years. Okay, a lot of this drop off. So this is where total ending supplies of corn are estimated to be as of September 1 next year, about 150 million metric tons. A lot of this drop off, though, is due to a rebalancing of China's stocks. Over the last couple of months, China's stocks have been lowered by, I believe, 30 million metric tons. So we'll never really know or believe statistics out of China until we start getting official government releases. That said, the USDA at least has pegged that as the present day situation. Where that ranks relative to history, though, is getting important. Obviously, we're not in a dire straits situation, but stocks are getting tighter on a global scale. So again, why is this important to you as a buyer? Right now, just to summarize corn, acres are coming down, but yields are going up, meaning that supplies are still ample for today. Unless we get super hot and super dry over the next 3 weeks, the growing season will finish out fine. In all likelihood, we'll finish yields above 170. Some are talking 180. I have no personal estimate at present. We'll see what happens in the next couple of weeks. Now, as you advance towards next year with South America, I'm assuming that more acres will go towards soybeans, given what we're about to talk about here on the soybean market with China import duties on U.S. soybean exports. Brazil is going to be encouraged to plant more soybeans and reduce corn acres. So big picture here, maybe acres are coming down, which means less supply for the future. Today, yes, very much ample supply, but tomorrow, maybe not. Domestically, demand is kind of hitting a wall. Unless you put some more birds down or get some more beef cows or dairy cows or swine out there, the demand for corn is probably plateaued at present. Let me dive into soybeans. Very similar structure here. We're going to go through price. We're going to go through supply and demand. Then I'm going to turn it over to Eric for some strategy comments. But here's the soybean meal. We're going to mix and match soybeans and soybean meal in here. Soybean meal has its own fundamentals, but they're primarily driven by the soybean market. Similar duration here for the chart. We're looking since last May. Meal prices were actually much lower. I mean, maybe not much, but relative to the high we saw this past spring, they were much lower last year. This is again why we talk about looking forward out in time. Since we don't know what the future holds, we can begin putting prices into historical context. I'll show you in the next slide where $300 ranked from a historical view. Suffice to say, prices though started increasing and then increased pretty rapidly though, going in from the turn of the calendar into May. More on that later. After May, a lot of issues subsided. I'll get into that in a second. And prices moderated a touch. And then May 29th, a famous day here in U.S. history, at least it will be from the agricultural world, the Chinese or the U.S. imposed tariffs on China imports, and all commodity prices started to fall. Okay, this is again a stale price, but I believe current prices are roughly in this area, $325 a short ton for the December contract. Where does that price rank relative to history? Over the last year, the 1 year term, this is an average price. It's not anything spectacular to buy. It's not absorbently high. This is an average price. Notice that the range has been about $295 up to that high we just saw in May of about $390. Over the last 5 years, also a very average price. Soybean meal has had some pretty significant support, and I'll get into that in a second. So, as you start thinking about where would I start targeting purchases for meal, you can see here that the $300 mark, that's not a forecast that's going to happen, but, if things continue to go as they are, and that being, weather's doing fine, issues with trade are occurring, there may be an opportunity for lower prices. We'll see. That said, if we don't finish the growing season off, higher prices are ahead of us. Let's talk supply and demand also. Same chart, obviously though related to soybean specific stats. On the right hand, 3 columns here, you're showing the June estimate for the USDA report and this recent July. Like corn, the WAOB includes the June acreage estimate, the final planted acres. Farmers intend to plant 89.6 million acres to soybeans, so it's an increase of 600,000 acres, and we're somehow going to harvest 100,000 more than that. That said, production higher due to increased acreage. Yields right now, again, it's a little too early for the USDA to start adjusting yields. That should start coming next month with the August WASDE report. But that said, just like corn, things are going well. Everything looks beautiful out there. So significant crop. We'll see if this does grow. The big issue, though, and the reason why beans continue to be lower, and soybean meal for that matter, is that exports were lowered 250 million bushels due to trade with China. So, the USDA actually made a comment in their USDA report here on Thursday, and I'd like to just read it because it's interesting. There's some, talk about Mexico with corn, right? And the USDA wants to make sure that they get it somewhat right. I know people, producers have issues with their with their estimates over time. That said, they're just trying to create some sort of regular order. So here's their note. Consistent with established practices, this report only considers those trade actions which are in place or have had formal announcement of effective dates as of the time of publication. So they go on further to talk about other things, but what that means is obviously they believe this is real with China, and obviously nobody's joking around, and that's why they are able and willing to say we are going to lose some pretty significant demand for exports there. Now, that said, they believe that because of lower prices being forecast due to that decreased demand, that there will be more availability for crush because of soybean prices being lower, and that would attribute to potentially lower soybean meal prices as well. Obviously, these are forecast in an ideal world. Okay. All told, though, ending stocks up 195 million bushels. That's huge. That's about double, right? It's 2 times, 50%. My math is failing on a Friday. 50% of what the USDA had estimated ending stocks to be last time. So, stocks being 150% of what they were expected to be back in June. Obviously, the marketplace didn't take that favorably. A lot of it was priced in already. Let's talk supply. Just like corn, it's an ever upward trending market here for yields. Soybean yields, it's just been great over the last several years, last 5 years, above average yields. I think what's interesting about this chart, there's only one time, at least in our data set, for a longer duration here, 1, 2, 3, 4, 5, 6, 7, 8, 9 years in a row of consistent over trend yields in the soybean market back in the 60s and into the early 70s. Every good thing comes to an end. And so while we have ample supply today, again, this is kind of the same motif here, the same story. I don't know what the future holds down in 2019, 2020, and 2021. There are futures contracts today that our buyers are looking at and beginning to manage those prices just in case the future changes, as it always does. So yields higher right now, continue to be above trend, but we'll see how that continues into the future. Here's that area chart of soybean plantings. Why have soybean plantings increased since 95, 96? Again, if I drew a horizontal line, not a whole lot changed through the 80s into the 90s. Dip in acres, obviously we had some corn acre increase there, CRP. But acres started increasing going into and including this year, and that's primarily due to exports. And that's why I think it's a very big deal what's going on with China. demand for soybeans, if we went back to that previous slide, and I encourage you to reference it after the webinar so I don't have to go back and mess this up, is that demand for soybeans, 50% or so is the export market. The other 50% is through crush. So this big increase in acres has been primarily due to the export market. So similar chart as with corn. The blue bars are showing domestic crush. You know, the U.S. has increased their supply of animals on feed, save for feedlots. Right, the feedlots obviously are down since the 70s, but you've got more chickens, you've got more turkeys, you've got more swine, and so demand obviously for that protein increasing. So crush has been moving higher through the decades, but not significantly over time. The big push, though, has been through exports. Okay, so if you look just in that 95, 96 time frame, the real increase, the much steeper one, has been through the export market. Okay? So acres are going towards exports. If, when, why, or how these shift, you know, that could have a pretty big impact to soybean and soybean meal markets. Okay. Let's talk about bean exports. Just breaking that category out, a huge increase. I mean, this is looking again in metric tons, but you know, back in '96 or so, let's call that 25 million metric tons. By the time we get a decade later, not a whole lot of growth, but going into 2016, we went from, from 2006 into 16, went from 30 million metric tons to 60 million metric tons shipped, twofold demand increase. And so we've been really reliant on increasing that soybean acreage base to meet that demand. And who's been that demander? Why are the bean exports going up? Well, it's what we've been talking about for, I can't even tell you how long. Been in this industry since 1996. We've been looking at this chart. If I erased these data points, I can remember back in 2006 saying, that was it. That's the high. They're not ever buying any more. And they continue and they continue and they continue. This is going to be the first year, at least right now, that it's expected that China's imports are going to be lower year over year. Okay. China's agricultural sector is trying to become more independent. They just don't have the land base. They're primarily using that land base for corn, right, other feed ingredients, and they're importing the raw soybeans and crushing for their own soybean meal. They've increased crush capacity significantly, and so that's what they're trying to do. That's their MO. That's their strategy. Don't worry about growing the beans, crush them, and take the products. And so what happens in the future? I don't know, but the longer these trade issues go on, the more China will be encouraged to seek an alternative supplier. We obviously know our friends and competitors in South America are growing their acreage bases every single year. So something to be aware of down the line. Let's talk specifically with meal. Soybean meal is a little bit different animal in that, obviously there's not much of an international market, I guess, from our perspective for soybean meal. Again, I encourage you, the USDA is an excellent resource for data and information and, just estimates or being able to develop an estimate or a bias. If you look at their estimates through the years, Argentina for soybean meal represents roughly 45 to 55% of all the world's meal exports. So, in other words, let's call it 50%. If the world is going to import 50 million metric tons of meal, Argentina supplies 25 of that, right? So Argentinian production of soybeans is a big deal. If they don't have the soybeans to crush, those buyers turn elsewhere to look for that supply. Okay, so while I set that up, I gave you a chance to get your eyes accustomed to all this busyness on the screen here. The top chart, what I'm trying to show is how price action was moving relative to the USDA estimates and the information that we were getting in the marketplace throughout time. A lot of times we just got to step back and say, how did we even get here? Each little block here, there's a little hash mark. So each block here is representing a change from the previous month's USDA report. And the change, the colored bar is going to be in blue, is going to be the change in Argentinian production. So this is a drop. The USDA is estimating that Argentinian production is lower than the previous month. The green bar is the Argentinian exports. So production down, they're estimating that exports might be down. Okay. The maroonish and the purple bars are looking at the same thing, but for the U.S. production. So the rhetoric, you hear the news, you read the news, and unfortunately the news is usually old and stale and has bias in it, in that there's an expectation that may or may not be real. So let's walk through time. In November, nothing was really happening in Argentina. Everything was going fine. In December as well, no change in the estimate for production for Argentina. Notice the price of meal for December futures below. November, December, sure, there were bumps and blips here, but in reality, the market was trending sideways, 320 to 340 in that range, and that's kind of what markets do. They just flutter around until something changes. As we started getting into January and latter part of January, middle of January, started getting really hot, started not raining, and Argentina started having issues. People started saying, are they going to have that supply? Notice what starts happening to our prices, our commodity prices for new crop meal. Now, this isn't even spot meal, but new crop meal start moving higher in the expectation that this could become a pretty dire situation. So what happens in February, the USDA lowers supply expectations for Argentina. Touches nothing, though, with the exports. As we start getting into February through weather, obviously Argentina is getting worse. Things are happening there that still aren't expected. And in March, the USDA lowers production again for Argentina, but also lowers exports. And now you get to see that prices really start moving because they expect our crush to increase. And all of that production is going to go into the export market. Okay? You know, and so if we're going to make up for all this demand, we're going to be the supplier, holy cow, meal prices can go up dramatically. April was really the final high. This was the final whoosh in terms of the big one, obviously. How much supply the USDA expected Argentina to not have. Exports down. But notice what the U.S. bars started doing. Production up, but not all that production is going to exports. And so the marketplace is starting to get an expectation that, wait, we're going to have more supply here than we already had. And it's not leaving through the export market. And notice what happens in May, right? Prices peak, prices moderate to see that next USDA report, to see if we're going to increase our share of world exports. And we're still not making up for adding to meal supplies domestically, and prices fall. Now, obviously, there was other things. You can't attribute market action to just one thing, but you know, tariffs obviously contributed greatly there too. Same chart for meal exports, as I showed with corn, the gray bar showing what's needed to meet the estimate for the USDA's forecast. These blue bars showing what has actually been shipped. So notice here, this is actually why, you know, the market finally made the last push to price highs, and we had some pretty good shipments going on. It'll be interesting to see how that continues into the future. The last couple of slides, and I want to turn it to Eric. Ending stocks. This is the new update for from the USDA. That 580 million bushel number is sitting here in metric tons of almost 16 million metric tons. A new almost all-time high of supply. Obviously, that's negative for prices, and the market is reacting in kind. Stocks-to-use ratio. It may be some time until we have fixed this situation, but we're getting into very loose periods here. You're looking at 05, 06 is the last time the stocks-to-use was this high. Prices were very well depressed into that period. One thing that last couple of charts, but as I'm flipping through here, I guess just to keep in the back of your mind, remember your buyers, and when low prices occur, that's a good thing. They don't always stay. There's a natural cycle that occurs through time, and it's a profitability cycle. While it feels good for you as a buyer to try to buy $3 corn and $300 meal, obviously you want lower meal, but it feels somewhat good to buy low commodity prices. The farmer hurts, and what happens is lower acres occur in time, and that drives commodity prices back up because there's less supply, less people in business to supply that commodity. So, keep that in mind as you look forward out in time. Eric's about to talk about strategies here, but here's the world picture for beans. Ending stocks in the world are ample. Argentina, Brazil doing a good job in production. And as the U.S. stocks-to-use ratio has increased pretty well, the world stocks-to-use ratio stays almost historically a record high. So again, ample supply in that marketplace. With that, I'm going to turn this over to Eric. And Eric's going to go through and walk through strategies that buyers can consider given the current market outlook. Eric?
Yeah, thanks, Mike. So just from a time constraint here, everyone, I'm going to focus on just some simple strategies that the buyer community has started to use with the break in the market. As Mike has highlighted, the markets have seen a pretty significant decline in price. And as a buyer, that is a good thing for you guys. So we have seen a lot of people in the end user type category, whether it is a turkey, egg, poultry, snack food, feed company, start to look at extending some pretty long coverage in the markets. So just wanted to take a couple minutes here and then leave some time for questions for both myself and Mike. You'll see this chart. This is the one that Mike started the presentation with. I just wanted to highlight it again to kind of talk about where corn, specifically December corn, is falling in terms of the range of 1, 3, 5, 10, and 15 years. As you can see, 367 price. We're currently trading a little bit below that now, about a dime lower than that today. But when we put this together, that is the price. So we're going to talk about a strategy based on that December corn price. Still very cheap. So just to highlight, buyers are utilizing this cheap price and looking at extending coverage. What types of coverage kind of varies depending on each specific company. There are many ways to look at protecting corn prices to higher levels. You can go out there and buy the futures market and actually own the board at the CME. You can go out there and buy cash positions, or you can utilize the options market and have some flexibility in your position. And that's the strategies that I'm going to focus on today, is actually the option market, because we are seeing a very large interest from buyers in having that flexibility. And I'll explain that here in the next slide. So what I wanted to kind of talk about was really the most simplest type option position, and that is a long call. You'll recognize this chart. This is the December corn chart that Mike's had up on the screen a couple times. This goes back to that same period last spring and summer. Right about here was the end of the year, where then we saw the nice rally that the corn markets had since January, which is where this bar is starting. And then, of course, we all know that the market has seen a very significant drop in price. So the strategy that we're going to kind of talk about is buy a corn 370 call at 18 cents per bushel. Okay. And the reason that we're looking at this corn call option is because it allows for the most flexible type idea based upon where the market is. Okay. So there are a lot of buyers that are currently looking at getting long, and there's a lot of buyers that are currently utilizing these option positions. So what does that mean when you go in and buy a corn call option at 18 cents? What it means, okay, is that you're putting a maximum price on the actual corn market itself. Okay, you can see here maximum corn price is $3.88. Where do we get that $3.88? That means that you're looking at the 370 strike price and you're adding your premium that you paid. Imagine it as a insurance policy. Okay? The cost of your insurance policy to protect against corn moving higher is coming at 18 cents per bushel. The green highlighted section here says unlimited protection to higher prices. Okay, so no matter what happens between now and the end of December, and when we get into harvest time, you are protected to higher prices. Your maximum corn price would equal $3.88. As you guys heard in the previous slides from Mike, there is a lot of uncertainty in the grain markets right now. Whether it's the acreage, whether it's the yield, whether it's exports, NAFTA, et cetera, there's a lot of uncertainty. With that uncertainty, that's why we want to utilize some flexible positions. The next little green bar here shows that you have the opportunity to participate in lower prices. So you are not actually going out and purchasing corn at $3.67 or $3.70. You are protecting corn at $3.67 or $3.70 with the opportunity to participate in all lower prices if this market were to continue to break. And that's why buyers love this type of strategy, because they know that it is a insurance policy to protect against higher prices as we head into harvest, but it does allow that opportunity to buy it as we move lower. And you'll get that here on this next slide. Okay. I want to explain this just briefly. Same position here, buying the call for 18 cents per bushel, unlimited protection to higher prices, maximum price, just to reiterate here, $3.88 per bushel. And you also have the opportunity to participate in lower prices. Okay, what we did is we have a scale here of corn price, and then this is kind of going to highlight what your net price will be at expiration. So right now at $3.67, you can see that we bought the 370 call for 18. That's the P&L here. Okay, at expiration, $3.85. As you move up the scale here, so if corn were to rally into expiration, let's say the corn market goes back up to $4.50. If you were to put this position on, your net price would be $3.88. And you can see here, $3.88 all the way up as high as corn goes. On the flip side of that, if corn were to continue to decline, okay, you can see what your net price is as the market goes down. It continues to get lower and lower and lower, and that's the benefit of having that call option in place. If corn goes to $3.30 at expiration, your price is going to be $3.48. You're going to buy your cash corn at $3.30 plus your 18-cent insurance policy gets you a net price of $3.48, which is roughly 20 cents better than the current market. The other graph over here shows it as of today. This gets a little bit more into options with using delta and showing what your delta is as the market goes higher or as the market declines. It also tells you what your P&L is if the market were to rally up to $4.50 based upon today's value as opposed to at expiration. The reason, okay, that clients and buyers are utilizing the long call strategy is because implied volatility is historically very low. And what does that mean? Implied volatility is the cost of that insurance policy. Okay, so you can see here the blue line is this year. The highlighted green and red is a min and a max of volatility. You can see on the dotted vertical line here, here's where we are today. And implied volatility is basically at a record low. So the cost of that insurance policy is very cheap. So for buyers, you're not spending a lot of capital to purchase and be able to protect against the potential for higher prices. That's why we look at just the long call by itself at this current time. This is looking at December 18 over the last 10 years. So that's corn. That's soybean meal. I'm just going to take a couple of minutes here to talk about so you guys can see the price of what that same strategy would be with the break in the market. We are also looking at having a flexible type position in place. You guys have seen this chart already. This is showing the 1, 3, 5, 10, and 15 year, and how soybean meal is actually a little bit higher in a historical context than where corn is. Here is your soybean meal chart going back to last summer. And you can see that we are getting back into some nice support levels here. So buyers are definitely taking advantage of this significant $70 to $75 per ton break in the market. Like Mike had mentioned earlier, $300 meal seems to be a very, very good support level and a target that most buyers would extend a lot of coverage. If we don't get to 300, how do I protect the current break in the market? Well, it's utilizing that call strategy again. So buying a soybean meal $330 call at roughly $16 per ton. Your maximum meal price is $346.20. But you basically right about where my cursor is on the screen. Same concept here. You've got unlimited protection to higher prices. And you also have the opportunity to participate in lower prices should we continue to decline. Very flexible strategy. Here's what the cost of the position would be. Wanted to give you the charts again just to show the price as the market continues to move higher. Let's just say we get back to $375 meal. Your net price is going to be $346 because you implemented this call strategy. If the market continues to decline to $295 or $300 per meal, you're going to be at roughly $311, $319, whatever the price is. Take into account your cost of your insurance policy or the cost of that call option. Wanted to show the implied volatility for soybean meal options. As you can see, very low from a historical perspective, so the cost of these strategies is very cheap. There are ways to cheapen up the strategy, but just to keep it for this webinar, we wanted to have the most simple strategy of a long call. Implied volatility is low. You want to buy options. You want to buy insurance policies when implied volatility is low. Take advantage of the break in the market. So just a couple strategies for corn and soybean meal that buyers have been utilizing over the last couple of weeks. Just kind of depends on if you want to buy cash, if you want to buy futures, or if you want to utilize the option strategies. The point is, and I think that the summary that we want to hammer home is, from a buyer, you want to take advantage of this break. There is still a lot of uncertainty in the market. We have not pulled a single bushel of corn or soybeans out of the field yet. A lot of uncertainty between now and harvest time. A lot of news, a lot of fundamentals going on as well that could add a lot of volatility to the market. Take a step back, realize that the prices have come significantly lower, and buyers have definitely taken advantage of it and are taking advantage of it at the current moment. Mike, do you want to talk about this last slide here?
Yeah, sure. So Eric, thanks a lot. Eric had mentioned a strategy that we could talk about in 10 minutes. Everyone hopefully is understanding what that strategy can do for you. Shows you the benefits and the drawbacks being the premium outlay. There's more strategies that our buyers are using, and we do host seminars. If you're interested in ever coming to a seminar, this would be some of the agenda highlighted for that duration. So feel free if you'd like to reach out to us in the future to learn more. And with that, Kevin, Sarah, that's all we had. Any questions?
Great. So we'll open up for questions. If you're on mute right now, you'll need to come off mute, or you can also ask questions in the chat bar, whichever you prefer. All right, well, if we have no questions, I appreciate everybody participation in today's webinar. Again, it has been recorded and will be linked to from our website on our YouTube channel, along with the other webinars that have taken place thus far. And we will soon announce the next webinar for the Iowa Poultry Association series. But thanks for your participation and have a good weekend, everyone.